Good afternoon, everyone. My name is Brian Overby. I'm the Senior Options Strategist with OptionsPlay. And today we're going to talk about credit spreads for passive income. Now, we've debated if we should call this for retirement accounts, but the way that we're going to approach this credit spread webinar, I guess today, is we talked a lot about setting up an IRA account or any type of retirement account. IRA is the easiest one. It could be a Roth, it could be a SEP IRA, it could be whatever you want to be trading in, by going to your brokerage firm and filling out the application, filling it out correctly, and getting proper approval. In this day and age, most brokerage firms will allow you to trade limited risk strategies in an IRA account. And today, that's what we're going to talk about. We're going to talk about something where you're going to have a little bit lower reward versus risk, but it's a strategy that can generate income on a monthly basis. It's a strategy that I would personally like to do in my retirement account. And mainly because if you're in a retirement account, one of the things that is nice about that is that you don't have to keep track of every transaction and worry about the tax situation and the tax issues that can come from selling shorter term option contracts over and over again. So that's going to be the theme today. We're going to look at a little bit longer term credit spreads and think of this as a way to generate passive income inside a retirement account or any account. Now, everything that we talk about today can be applied to any type of account, but that's going to be my main focus. Okay, so with that mentioned, we're going to try to go 30 minutes today. We're trying to shorten these a little bit. We will have a Q&A at the end, but OptionsPlay is committed to education, and we do these events every Thursday and always come up with a different topic. The topics are generated by what we hear from our members inside OptionsPlay, and one of the most popular strategies is the credit spread strategy, otherwise known as a short vertical spread. All right, so let's define those strategies a little bit. Now, here's important information. When we get to the end of the show, we're going to show some real quotes using the OptionsPlay platform and some of the search features. They're not meant to be recommendations. Past performance is not a guarantee of future results. So we always got to put that out there. And then here's your opportunity to sign up for OptionsPlay. Go ahead and grab your phone, hit that QR code, or you can just go to optionsplay.com and you can sign up for our free 30-day trial. 100% no obligation for the first 30 days if you would like to try it out, and you'll get access to all the tools that we'd be using today, on top of the fact that you're going to get daily trade ideas. Every morning we put out a daily trade email based off of usually some of the search features that are inside the OptionsPlay platform, or we like to use the research paper that Tony puts together every Monday morning. He also refreshes it and puts it out on Thursdays. So the research team at OptionsPlay puts together a nice little PDF that highlights some sectors of the marketplace and then gets into bullish and bearish trades on particular underlyings based a lot on the fundamentals of the company, but then we try to grab those fundamentals in that situation and take a technical aspect and then try to come up with a daily play day in and day out. If you're interested in that, if you scan that QR code, you can actually sign up via the Zoom platform, which is also displayed on YouTube, on the YouTube channel, and you can get access to all of those events and get an alert every morning if you would like. It's a great presentation. I listen to it almost every Monday after Tony gets done with it. All right, so 4 basic positions. We're going to be just looking at the seller side of things. We're going to be talking about selling option contracts. If we sell a call option, we're considered short. We're going to take on an obligation to sell that underlying stock, which means if we have that obligation, we're going to be bearish on the market. Another way to say that is if you buy a call, you're bullish. So if you sell a call, you're bearish. Now, we're going to be neutral to bearish. We're going to be okay if the market just stays where it's at. And then if you're bullish on the put side of things, we're going to focus on selling that put option, which is an obligation to buy. So if you're taking on the obligation to buy, that means you want the market to go up. You are bullish on the market. Another way to say that is if you buy a put, you want the market to go down. If you sell a put, you want the market to go up. Sellers take on obligation and they receive cash for taking on that obligation. All right. So what is a short vertical spread? So we're going to go over a very succinct definition of short spreads. Now, there's a lot of different names for them. First off, you have a bull put spread, and that just goes right along with the bullish term. I think that that is probably the most common and most descriptive name in the options marketplace. But there's also, if you are a professional, a lot of people call it a vertical spread. And it's quite simple that when the Chicago Board Option Exchange first opened its doors in 1973 and the traders were standing in the pit and a spread order came into the pit, it would get walked into the pit. Nothing was done electronically with spreads back then. And the market makers, after they heard the strikes, would have to look vertically on the quote boards to come up with a midpoint, or a bid-ask spread, I should say, not a midpoint really, a bid-ask spread for executing both legs of those spreads. So you had to look vertically on the quote boards, and hence the name vertical comes around. And I think it's helpful to kind of understand that. But that also, and this is where some of the other terms, like with time spreads, where you buy different month option contracts and sell different month option contracts, that is actually called a horizontal. And then if you're doing that and you buy and sell different strikes, different months and different strikes, well, that's actually referred to as a diagonal. So those are where those terms came from down on the trading floor way back in the day. So the most common thing, if you are bullish on the market, is to look at a bull put spread. If you are bullish on the market, another short vertical would be a bear call spread. All right, now these are the thoughts that are behind it. You're neutral to bullish or bearish. You receive a net credit up front. You get that credit. You can use that credit for whatever you'd like, but most of the time you're going to have a margin requirement based off of the width of the spreads. You can use that credit to help offset that cost of that margin requirement. And higher probability of success, right? Because bottom line is if the market just stays where it's at, time decay is your friend. We're selling premium, and time decay is a main reason, probably one of the biggest reasons why you want to consider doing short spreads in general. All right, so here is the bull put vertical spread. If we put this on, we're selling a put so that the stock is right here and you're bullish on the market, right? You buy the stock, where you cross the zero line is your break even. So you have substantial upside, but substantial downside. Now, if we just sold the put, we bring in a lot of premium. We're not going to spend any more to buy protection. But then this profit and loss graph continues on down. We buy it at a lower price, receive a premium, but then we have substantial downside if the market goes down, and we still have unlimited upside. If we buy it, we would just basically own this stock, but what would happen is the stock would move over here and your break-even price would be right here on owning the stock. So selling puts on stocks that you don't mind buying is called a cash secured put, and I always like to emphasize that that can be done in an IRA account. If you have the ability to buy the stock and you have the cash, and by the ability I mean you have the cash to buy the stock, well, it's okay to sell a put in an IRA account, saying that if stock comes down to my strike price and gets put to me, that I'm willing to buy it at that lower price. Not much different than a limit order. And sometimes if you're in a stock that's more volatile, a bull put spread or a short put spread is an alternative to just selling the put outright. I'm in a volatile stock. I'm getting a lot of premium because of that. So because I'm bringing in so much of a credit from selling the put, I might take some of that credit and buy some protection. So I still plan on buying the stock. I'm just a little bit worried about the short term and the volatility that could happen around with that. And that would be the concept of a short put spread as an alternative to a cash secured put. All right. And I do that quite a bit on volatile stocks. I've done that a few times with NVIDIA inside my IRA account where I did a bull put spread instead of just selling the put outright. When bottom fishing in NVIDIA, that type of scenario. That's a great example of when you might do a short put spread to try to buy a fairly higher price stock that has some volatility, but some predictability in it. That's ultimately what you want, right? It's kind of an oxymoron, but that's really where you're at. And I want to let you know too that if you open up your Q&A box, before I go on to the next one, I forgot to mention this. If you open up your Q&A box, you can ask questions during the event, and I'll try to address them a little bit later on the show. I'm going to get through the slides, and then we'll try to address it when we start talking about the OptionsPlay platform. But feel free to allow that, or to open up that chat box, or I should say Q&A box, and start building up the questions. I see a couple of people have already put a couple in right now. All right, we'll start going here shortly. I'll answer. I see the couple of questions that are in there. We'll answer them, like I said, in just a little bit. Let me get through these couple of slides. All right, bear call vertical spread. So limited to the net credit you receive when you set up the strategy, limited to the difference between the strikes minus the net credit received. This is an alternative to selling stock short. Selling stock short is not easy to do, right? You need to be able to get the shares, you're gonna sell it, hope the market goes down, and then you buy it at a lower price and you replace those shares. So one way to get bearish is to sell a short call. Now, you cannot sell a short call in an IRA account without having it covered. In other words, you can only do a bear call spread. You cannot do naked short call options in an IRA account. And that's mainly because the risk isn't defined. Anything where the risk isn't, you can't buy stocks on margin because the risk, well, I guess the risk is kind of defined, but they don't allow it. You know, I guess stock could only go to zero, right? But that's what I meant by kind of. But ideally, you can't use a margin account in an IRA account, and you cannot sell a call short without protection. But you can do it with protection. As long as the loss is limited and known, the brokerage firm can account for it, and they'll hold out the margin requirement, and they will allow you to do bear call spreads inside retirement accounts. And I'm just going to call them IRAs just because I'm old school, I guess. That's the way to look at it. All right. So in this scenario, this trade came up a while back, and I'll just kind of put it together because once we get into the live markets, once we get into the platform, we're just going to be using real numbers. And I just want you to actually have a slide that shows a bear call spread that we actually did as part of a daily play way back in the day, where we came out and we got a notification inside the OptionsPlay platform that it was a momentum-based notification. And we decided to sell the June 7:30 call. This was an expiration this year, 43 days out, and that's what we're going to concentrate on today. We're going to concentrate on ones that go out about 40 days or so because we're thinking about income in a retirement account. And so we're going to be a little bit conservative on the trades that we do, and I'll try to answer a little bit why that's going to be the standard. But with the market trading at 366, we sold the 370, bought the 390, brought in $7.73 on our capital. That's $773. Now, we just need the market to either stay where it's at or drift lower. It could even drift a little bit higher. As long as it stays below 370, we'll be okay on that trade. Now, a lot of things that the OptionsPlay platform is going to try to do is they're going to try to find things that have a decent risk reward. So the platform is a starting point. It's not an end all. And I've had this question a couple of times with a couple of vertical spreads that I've done in the daily play as part of the daily play, because earnings season comes around every quarter and it's a known event. And sometimes we'll do strategies that will avoid that known event, meaning we might do a shorter term expiration because we don't want to ride it through earnings. Or we might do expirations that definitely cover that event because we think that fundamentally the company is being undervalued, and because of that, we want to be around during the earnings event. So I get that question a lot. I always want to say that this is a starting point, and you can manipulate inside the profile if you want to look at 30-day, if you want to look at 40-day, if you want to look at 10-day option contracts, and that's all that you want given. But the standard approach from the OptionsPlay platform is that we're going to go out about 43 days. We're going to put the trade on. If the rules apply and it works out for us, we're going to close it. If they go against us, we're going to close it based off of our rules. And then when we set it up, we're looking for a risk-reward ratio of about 60%. So that basically means if you're saying this, and now this is quoted wrong quite often. It's really a reward to risk ratio, but the pundits on the shows talk a little, usually when they're talking about options, they'll say a risk reward ratio, which would imply that you are putting the risk on the top half and the reward on the bottom half. All right. So if it is a risk reward ratio, you would invert it. So I put this in the slide. We'll make the slide available to you. And I just explained that because that's always bothered me. But it basically means that it tells you that for every dollar you're putting at risk, you could earn 60 cents if the trade works out. All right. So a ratio with less than 1 means that the potential loss is greater than the potential gain. And that is very true about bear call spreads. But so the platform is going to be more apt to sell more at the money option contracts or just out of the money like we have in this scenario, because they want this ratio to be 6.1 to 1 or 60 cents to 1 on every dollar, depending on how you do the math. And if you invert it, this is the way the math would work out. I'm not going to read that verbatim. But if you do this trade, now, I look at vertical spreads a lot of times is you have a lot of risk. And if it starts going against you, if you don't bring in enough premium, this is my rationale behind why the platform works the way it does. Now, I wasn't around when OptionsPlay was made, and Tony and his team across the board has made strides and tweaked so many things. And recently, Tony's been adding a lot of stuff to the platform, which I think is just wonderful. But if the market is going against you when you're doing these vertical spreads and you don't have a lot of premium, say that you want a little bit further out of the money, and let's say we sold and I'm just going to make up some numbers here, the 375 or maybe even the 380 strike call option, and the market goes against us, and we bring in, we're risking $1 to try to make $10, right? With $10 of risk. So we bring in $1 and our max risk is 10, meaning that we have $9 at risk, or the width of the spread is 10. If the market goes against you, man, it's hard to stay in that position, right? Because if the market starts going against you right away, there's really no buffer. The time decay is $1, and that's the most that you could make if it doesn't go against you. So to me, I like to be a little bit tighter on these spreads because it gives me the flexibility of staying in it a little bit longer, because time decay is my friend. And even if it's moving against me, time decay is still working for me, if that makes sense, right? I still have an issue if it goes to 390 and it expires above 390 at expiration. That is an issue, and I'm gonna lose the maximum on my trade. I can't stop that. But at least if I'm doing this trade, I'm getting some real time decay by selling this option contract. All right. All right. So with that said, let's we're going to back out here. I'm going to not show my screen. I don't want to, because I've made a mistake the last time around. If you guys were weary or privy to that, where I didn't share the right screen after I moved out. So here we go. Here's the OptionsPlay platform. And I want to highlight a couple of things that Tony has put together here just recently. And it's more so in the watch list. And he also threw, we're going to try to make this a little bit more user-friendly going forward. You have the ideas tab, and that's where we default to. But right now, we have a bunch of global watch lists. And my favorite ones, and the ones that were recently added, are overvalued stocks and undervalued stocks. Now, in general, if you're just thinking of overvalued, that's exactly what it is. Fundamentally, it's a undervalued stock. So if you're thinking about just buying a stock outright and you aren't into the meme craze, right, where you don't really care about valuations, you care more about momentum, this is a list of those type of stocks. Now, we're combining with this undervalued list some momentum indicators that go along with it. And in particular, when stocks are undervalued and they also get beaten up too much is what we're going for by putting this trade together. So if you click on, now I'm going to highlight this because it is a little bit buried in here. It's not under the ideas, it's under the watch lists. And you scroll down and you hit overvalued watch list. It's right here. It says there's 126 stocks. And one of the things that Tony and I talked about is, 126 stocks, how do you pick? It's too many. We need to whittle that down and come up with different ideas that go along with it. So we added the light bulb, right out of Minions, I think. But with that said, light bulb, if you click on it, this will actually highlight trades and highlight them if you just happen to be in the platform by showing you a light bulb inside. And this is the one that is here is Cleveland Cliffs. I don't know if I'm that excited about Cleveland Cliffs, but with that said, this one's political. I don't know why this one popped up first. But with that said, here's what it means, okay? Cleveland Cliff has recently experienced a pullback within a longer-term bullish trend that may provide a favorable risk-reward for a bullish trade. So there are a couple of things in here that are interesting. The fact that it trades at a below average PE, so this company has earnings. It's a strong company as far as books are concerned, but it's really getting political issues are an issue, and the relative strength is a little bit low. So if I'm buying undervalued stocks and I am trying to cherry pick the bottom, and I am going to be selling some premium. One of the things is, as volatility has gone up as the market goes down, I want the relative strength to be low. I want it to not be at a high range. The lower, the better. 1, 2, or 3 is usually a better scenario. But this stock is obviously, look at all the red candles, right? This stock has really gotten beaten up. So we're using the momentum indicator and the overvalued list to come up with 30 different ideas. So let's scroll through this real time. Costco is an interesting one, but that's a bearish trend following idea. And Costco is obviously been a stalwart. It's really been a mover recently. Corning is interesting, but the market, so that's a bearish trade, a counter trend that we're looking at in Corning. Overvalued stocks, 30. Oh, let's do, that's what, I clicked on the wrong one. That's why I didn't want overvalued, I want undervalued. I want stocks that we can sell credit spreads on, put credit spreads. All right, that makes more sense to me. Okay, so in this, Adobe's going to be an interesting one. It's fairly liquid. I don't mind that underlying. The strength is 2 in this. Oh, let's hit ideas. Fang style. Oh, deck. Let's do deck. All right. So if I go, this is literally build decks. Deckers Outdoor. They do the plastic decks. It trades at about a 16 PE, a little bit undervalued. The market pulled up and we're pulling back. Area consolidation has recently experienced a pullback with a longer term bullish trend that may provide a favorable risk reward ratio. We're trading down on the low end here. We still got a bullish a 1 month outlook and a neutral outlook 2 to 1. So to me, this looks like a very interesting underlying. It's not as liquid, but we're selling put spreads, so we'll take a peek at how liquid that is. But I do pay attention to that. If I'm looking at underlyings, you prefer to have this thing say somewhat liquid or liquid overall, but we can avoid earnings. So we're going out, October is 23rd is far out. If I'm in a retirement account, I want to avoid earnings. I don't want to be doing these spreads. They're too speculative around earnings. So one of the things that I want to look for is that earnings report. So I'm going to click on high volatility. I'm going to look at the 195 put spread, not bad at all. It's given it a mark of 84. So that implies that it might have a little bit different risk reward scenario. The higher this number, usually the better reward risk or risk. I'll just call it risk reward. I'll stick with the trend of the industry, right? And that's usually a big factor in the options play score. So let's hit modify. We're going to hit the midpoint of it. So that jumped it quite a bit. So the bid-ask spreads are a little bit wide in it. We're at 95. If we can fill at the midpoint, the option score is 91. We click trade, and you'll notice here, there are no earnings dates between now and the expiration of your strategy. The bid-ask spread is fairly large, and that is a scary scenario, and that's basically what it's saying. And this isn't bad as far as the spread is concerned, because you can usually fill fairly close to a midpoint on a decently liquid underlying, and we're at 155 by 2. The midpoint is 177, and that's where I would want to execute it. So inside the platform, I've already set up a watch list, and if you want to follow your trades, I just called it credit spreads. I'm going to add that to the trade, and then I'm going to add that position. And once I do that, inside our portfolio of stocks, it shows here's our put vertical spread, and here's where we filled that trade at. We sold, if we got the midpoint, it was 177. Our net credit to the account was 177. We have 5 points of risk. So if we look at the risk reward, we're looking at, or the reward to risk, 177 divided by 323. Yeah, so we're a little bit under the number. If we were at 0.60 risk reward, we would be looking at somewhere close to an options play score of close to 100. We're at 91. It's saying it's a solid trade. It's still in amber, saying that this is an okay trade to do, but it's not the the most awesome trade that we can come up with. And every underlying is going to be different. There is no doubt about the fact that a credit spread in NVIDIA is going to have a different risk-reward profile and ratio than a credit spread in DEC if you do it on a similar basis, similar to the size and price of the underlying stock. Because volatility is different, and volatility will definitely affect the spread. So this is in our portfolio. We can keep it there. If we want to close out the trade, we click on it. We want to adjust the trade, we click on it. And we click close position, and you could click trade, and that would be the trade if you were closing that position out on it. And that's literally how the system works. Now I'm going to go back and we're going to look at the rules of it, but we'll look at another couple of trade ideas. The other one, if you're looking more so for, we'll do credit spreads. If you're looking for ones that are going to have a better risk reward ratio, then this is in the ideas, and this is the credit spreads. So now you're doing it more so based off of the premium on your option contracts as opposed to the fundamentals and the technicals, if that makes sense. And I see a lot of questions are popping up. Deckers, I'm sorry, Deckers makes shoes. I thought it was, well, Live and learn. Is that the case? I thought that they were the deck company. They make shoes. All right. So if I go and I look at the other type of searches that are in the OptionsPlay platform, right? This is going to be based off of premium, the width versus the spread, and what type of premium you can bring in if you do these type of option contracts. So here's a bearish call spread in Procter & Gamble, and we click on that. And if we do this, we see that the max reward is 133. The max risk is 307. Let's modify that. And you'll see that the number that is popping up here on our short call vertical spread is 104. So if you want to do the math and we click trade, the reward is 193 and the risk is 307. 193 divided by 307 is 0.62. So it fits the risk reward profile. Because of that, you get a higher OptionsPlay score. And this is based off of a bearish outlook in Procter & Gamble, selling, once again, we're selling the 155 strike, bringing in some real premium, only going 5 points wide, and we're sticking with the 43 days to expiration outlook on that trade. All right. Too bouncy. I don't know where that comes from. Maybe the underlying stock. Shoes and apparel. I apologize. What is the one that I'm thinking of that does DEX? Starts with DEX. I apologize for my ignorance on it. Yeah, but it's a company that does it. All right, no worries. I don't want to put any more egg on my face than I already have. All right, so let's go back and finish the presentation. Then I'll come back and do the Q&A. So I'm going to jump back out here, and I'm just going to talk about some of the rules that we have inside. These rules are already embedded in your watch lists, in the daily play portfolio of stocks. We have the rules already embedded in there, and you will get alerts when a lot of these rules happen. You'll get take a profit alert. You will receive a take a loss alert inside that platform. You'll get an earnings alert. The company is going to announce earnings. So if I'm looking at these trades right now, I'm trying to avoid earnings. If I'm in a retirement account, I don't mind doing it. If you want that type of speculation, I just feel like in a retirement account, doing spreads is enough of a risk versus reward situation that I do like to avoid earnings. So here's the 3 simple credit rules that are inside the OptionsPlay platform. First of all, usually recommend going out 43 days. And the idea would be somewhere around them. You're not going to get that far. I said 43 days because that's what we came up with. Somewhere around the 45 days to period. Now, this is just after doing iteration after iteration of short spreads. This is an ideal scenario where you have a nice rate of time decay, but if you're wrong, you can still adjust and get out of the trade. So if you're on the short, if you want to do 0 DTE option contracts, we've done many webinars on them. We've done a lot of them even with Mr. Sosnoff, and talked about how you want to approach them. And obviously high risk, high reward, almost 10 times the risk versus the reward when you're looking at very short-term trades. And you have to approach it that way. Once again, I'm focusing a little bit more on the retirement account. So if we look at this, we're going to exit with a 50% of max gain, implying that if I put this trade on in the Home Depot example for $7 and we could close it for around $3.50, we're going to do that. That's going to be our rule, and you're going to get alert inside the OptionsPlay paper trading portfolio that we're at that 50% profit of max gain. And then the max loss. So if I put on a $7 trade and that spread I think was 20 points wide. So if we were down $14 and we received $7 net credit, we're going to be at 100% of our max gain. And you're going to receive an alert inside the platform saying you might want to think about closing the trade. Now, I don't mind if you adjust these rules, but you want to stay uniform with your plan. Make a plan and trade your plan, right? And these are the first two most important rules. And I'm just letting you know that this is what the OptionsPlay platform will do for you if you use the paper trading portfolio. And then rule number 3 is if number 1 or 2 does not close, just close the position at the 21 DTE mark. And if you decide you want to do 30-day credit spreads, maybe I always like to think about halfway through the position. If the position does not perform for you and doesn't make a decision on what it's going to do, well, then I want to think about just getting out of the trade. You know, I might be up a dime, I might be down a nickel. You know, I might be up half of the max profit that I want, or I say 25% of the max gain. Well, at this point in time, I'm just going to move on, and I'm going to move on with that trade. And this is the scenario. Once you get down, if you got 45 days, you get down to the last 21 days, time decay just starts to skyrocket, right? And that really hurts your position, doesn't give your position that much time to work out. And yeah, it's a delta, gamma, theta, vega, rho really get interesting from 21 days on in. All the Greeks on the options trading world. All right, so we're right at about 25 minutes, 40 minutes, I guess. Let's go and take a stop here, and we're going to answer some questions. So I want to pause, and I'm going to put up one more time the free trial for 30 days. And then I'm going to mention my x.com handle, which is at Brian Overby. OptionsPlay is the website. You can sign up for a free 30-day trial there. And I have a little book called Options Playbook if you want to check that out. So now we're going to pause. And if you have any questions, I'm going to go and I will address those questions at the tail end of this show. Thanks for stopping in, everybody that has been watching and enjoying the presentation on credit spreads.